Hello and welcome to the second episode of the High Signal podcast. I'm Ian Randle. I'm here with my co-host, Sean.
Hey guys, how's it going? Hope you all survived Friday blood times. So yeah,
Yeah, a lot to unpack this week. And Sean also just got back from Token 2049. But that was kind of the reason I'm kind of stumbling over is that was going to be the whole podcast was like, wow, what happened to Token? Let's go through the whole thing. But one or two things happened in the meantime. So we've kind of pivoted and we want to take you today through kind of this, all of this activity that's been going on and unpacking a little bit for you. So yeah, where do we start, Sean?
yeah. Well, I think it was bloody, really. Probably one of the, I don't know, darkest, dirtiest, most painful days that I've seen. I think $19 billion was wiped out across liquidations, primarily longs, obviously, um, over the October 10, October 11, 24th, 24-hour period. And so on this first tweet, so this is from Crypto Titan, it's a really good chart sort of showing how quickly prices absolutely plummeted. And we'll sort of talk through a lot of the reasoning as to why this was such a sharp drop, but also why there was such a sudden and quick recovery very much after the fact. So, you can sort of see here the majors, Bitcoin, ETH, Sol, all down to their nut low of about, 12 to 25%. But they quickly recovered, right? So, they would quickly sort of everything ended up down for the day, but the pain was substantially less than the initial dump would suggest. What was really striking about this sort of flash crash was how badly alts fared. So, to me, one of the most surprising things was Hyperliquid or the Hype token dropping more than 50%. You can see it's 54% here, dropped down to basically just over $20 before rallying back to 38 to close. That is really wild volatility. But you see this with everything else, right? Like DOT, SUI, TON, AVAX, the whole shebang. Obviously, those are a lot less liquid, and that's part of the reason why we saw this flash crash. But frankly, I haven't seen anything like this in quite a while.
There's also a really interesting little piece of maths that might seem simple to you, but I think for many people is a bit confusing, which is when you see, oh, let's just take the top one, Cass. We dumped 86, nearly 87%. But we rebounded 486%. So we're good, right? We're up overall. And I think it's interesting just to unpack and explain, exactly how the maths work in terms of you being in a position, losing money, and then how many multiples of that you need to get back. Probably not that complicated to a quant though, right, Sean?
No, no, but I mean, I guess you learn this pretty quickly if you've, like me, have lost a lot of money trading perps. But let's say you lose 50% of your money, so you go from $1,000 down to $500. If you want to make it all back, if you want to rebound to where you originally started, then you'd have to go up 100%, right? So you can go down 99% to have 1% of your final money, but to go back to where you started, you have to go up 1,000%, or can't do the maths on top of my head, but that's sort of why you see. And so for the people who are listening on audio only, you would see like a token go down 86% from like say 8 cents to 1 cent, and then you'd see it rebound to 6 cents. And the rebound percentage from the nut low of 1 cent would be like an increase of 500%, which is absurd, but really just sort of reflects how quick this turnaround happened. And again, as we'll get into, this is all really just a function of liquidity, right? We really saw how thin some of these markets can be, especially on the altcoins. And we'll talk a bit later about like how reflective of true value these market prices are currently sitting at.
Yeah, I think it's helpful to explain. Just one more point wanted to make on the rebound piece, which is I think one of the reasons we might not have seen the V-shaped rebound we're all hoping for is just that, if crypto is now TradFi money and institutional money, the markets are obviously been closed when this whole bloodbath's been occurring, and it's a US holiday on Monday. So we might have to wait until Tuesday before we see any kind of TradFi cash reaction.
There is some speculation as well, and we can talk about this when we get to the Wintermute question. Like people are speculating, like, did Crypto.com blow up? Did Wintermute blow up? Did all these other funds blow up? Like, to me, there's not much evidence to suggest that's the case. If they did, it does take a few days for the fallout to settle and like the real damage to show. I don't think Wintermute has blown up, for the record. I think they're doing just fine. I think they probably made quite a bit of money on Friday. But that said, I think that, a lot of this fallout will take a couple of days to sort of to manifest itself. If you just liquidated a bunch of people and bought a bunch of longs, you're going to try and offload that. And you're going to try and offload those deltas to, say, institutional investors or people who will wake up and go to the office on, in this case, Tuesday. So we'll really see the full effect in the coming days, but seems okay for now.
There was I actually tweeted myself because so many people were talking about where did all the money go? Where is all this money we just lost gone? And it speaks to exactly what you said about suspecting, the solvency of Wintermute was brought into question. It's a zero-sum game in perps, right? So there's a counterparty that is doing equally as well as the other side is doing poorly. So, I did a quick diagram in a tweet that I put out about kind of, it would be LPs or vaults in a DEX, and it would be the other side or a market maker in a SEX. So either way, there's no one losing money. It's a bit like I was helping my son with his research for his science GCSEs recently, and there was this great quote that we all know about: energy cannot be destroyed, only converted. Right? That there's this constant sum of energy in the universe. Same thing with liquidity in perps. It can't be destroyed. It can only be moved around and transformed. So amazing how many people don't quite understand that, but important to understand.
Yeah, definitely something we'll get into later. For now, I wanted to talk about a bullet that was dodged. It might not feel it to some, but frankly, I think that last Friday could have gone a whole lot worse. We saw USDE depeg quite substantially, albeit very briefly, to 65 cents. I know at some point it sort of settled at around 94 cents when I looked on CoinGecko, and it has since fully repegged. I think there are a lot of concerns that because people like to lever loop a lot of these yield-bearing strategies, this could have caused further cascades of liquidations. So I think that warrants maybe a little bit more justification. So like typically if you hold, let's say, $100,000 of USDE, you're receiving points or whatever for that. You want to lever up on those points. So what you do is you go to a place like Aave with 100,000 USDE, and you might borrow, 90,000 USDC against that. You'd swap it for more USDE, plonk it back, and you'd borrow more. So eventually you'd borrow up, maybe let's say, I'm just pulling a number out here, you'd have like 500,000 USDE and 400,000 USDC debt. Now, the worry is that if this USDE depegs, then that position would be liquidated, right? So you'd have a huge cascade of liquidations resulting from that, and that would obviously be quite a painful experience. And that would obviously take the 19 billion we saw liquidated on Friday much, much higher, right? Because the thing with these levered looping strategies, because people want to earn some very nice stable yield, the thing with that is because the sizes are so ginormous. And had this peg sort of been reflected in the Oracle prices and actually led to liquidations, it would have been a considerably worse day. But thankfully, everything is good. So yeah, that seems all good. But a very concerning thing to see. But that's really just, again, flash crash mechanics for you. All kinds of weird things happen. I think I saw USDT trade up at maybe a 60 basis points premium or something like that. I saw some bridged version of USDC also spike to like $1.2. So all of that stuff, really, really wild. And if you have the guts and the edge to make a trade at that point, and catch that falling knife, it can be extremely profitable. It hasn't for me, so I would say that's a point of warning.
Yeah, I actually I played DPEGs last time around, and yeah, it's awesome, right? Because it just comes down to a question of belief. Do you believe that the backing treasuries are there? And I feel like this cycle, we're not even questioning that anymore, really. I think there's been a legitimacy brought to USDT and USDC and some of the other major stables. But it also touches back on my last point about it can't be destroyed. It just kind of moves around. Well, where does it typically go if you're forced liquidated on an exchange? It typically goes to one of those stables. So you should see stables rising in as things kind of crash out. You should see every bit that's come out of whichever coin it was denominated in back to USDT. I think is the number one by quite some distance. And indeed, I've looked at that, and you can see that in the charts. So again, it didn't go anywhere. It just moved into stables because that's the liquidation currency, so to speak.
Yeah, look, in one of these flash crashes, no one wants to be holding like spot ETH or spot Bitcoin. You want to hold USDC. You want to hold stable coins as everything is dropping around you. That naturally can create a premium for these stable coins because they can't be arbitraged fast enough. So it happens. USD depegging is probably because a lot of people were worried about, say, auto deleveraging on Binance, or just wanted to swap into a much more, liquid stablecoin like USDC or USDT, and that naturally creates, this, well, in this case, quite substantial depeg. But if you've been around in the industry long enough, you've seen a lot of these things. I remember, I guess, probably the most scared I've ever been was the USDC depeg down to 85 cents. That was truly terrifying. This was bad. I think that for me was more scary because I had a vast amount of money in USDC, and I remember frantically swapping into ETH at that point, going, well, at least I'll have something if this goes to zero. So
I had a decent amount of money on chain and did the opposite. Frantically got into USDC at 85 cents as much as I possibly could. And then I think it went slightly over as it came back as well. I think I sold at like 101 or something.
I
didn't do it this time.
I wasn't following what was going on at the time. I think I just woke up and I just saw like it was at 85 cents on the dollar. I'm like, what the fuck? And yeah, I think ETH, I'm like, well, look, at least like I know ETH won't be going away. So yeah.
That's the other point I was going to make to you about when you're saying you don't want to be left holding ETH or Bitcoin. It depends if you're like, it depends on your time horizon, right? If you're a trader, then you're spot on. You don't want to be left holding that because it limits your ammunition, right? To take advantage and be opportunistic about what's happening. But if you're like one of these, get your Bitcoin, take it off exchanges, drop it onto a hard wallet, an air-gapped hard wallet in a vault in Switzerland, if your time horizon's 20 years, you don't care. This is just the volatility that the asset comes with. So, but for sure, I think the majority of our audience, and certainly the demographic that we work with every day with Derive, I think they're trading, right? They're looking for trading opportunities. So in that sense, you'd rather be in stables, and it gives you more opportunity to react.
For sure. Moving on. I think quickly. Look, it wasn't just the crypto market that had a very terrible Friday. The US market had, I think, about 3% down. I think SPOs were down 3%. Here you can see the tweet is 1.6 trillion wiped out of the US stock market. Again, all of this is because of what we'll talk about very soon, which was an heightened risk of a trade war with China as Trump announced 100% tariffs on Chinese imports. And so we can talk a little bit more about that. But broadly, rest assured the TradFi people are also hurting a little bit with Friday's downturn. So quickly, just with some other things, volatility has, I didn't swap tabs. Volatility had a huge spike on Friday, unsurprisingly. So what you can see here is the dark blue line is Bitcoin daily volatility. And that spiked from really like 35% all the way up to almost 100%, right? So for Bitcoin, whose volatility has been extraordinarily flat in the last couple of months, this was quite the sight to behold. Now, like you saw a small increase in volatility for like longer dated expiries. So what that means is like traders were expecting some of this volatility to pervade slightly into like the longer dated expiries. And for the 180 day, you can sort of imagine a lot of the volatility was smoothed out, right? So a big shock like today really is just going to impact the next week or so, but some of it might pervade. And like, obviously things like tariffs, those things persist. So it could slightly increase the volatility for longer dated horizons. And so you can sort of see that here. So for those people at home or people just listening, this is the term structure of volatility. So on the x-axis, you have the various days to expiration, so various times. And the orange line is the volatility for I think this is also, I don't think this is ETH actually. Sorry. So this is ETH now. But basically, you see a large spike in volatility for the 1 to 7 days. So the market is predicting that we're going to see a lot of volatility in the next week or so. Unsurprising given what we've just seen. And so overlaid on top of this is the sort of box and whisker plots of the last 30 days worth of volatility data. So you can sort of see that the vols that we're seeing, so essentially what that means is we want to sort of see what are the volatility levels for each expiry now relative to the last 30 days. And obviously they're all kind of well above what we've seen in the last month. And so what that tells us is that the market is definitely pricing in a substantial increase in volatility, not even just for the short dateds, but also for some of the longer dateds, right? So 30, 60, and 90 days you can see like a lot above the previous max volatilities that we've seen. So going to see a lot of vol coming around. So if you're into volatility trading, it's a great time to be one. Very quickly,
Sean, just to point on volatility, is it worth talking about how Aave can be a predictor of things? Because I know, shout out to your article in our recent Derive Insights, you pointed out a couple of kind of Aave deviations or kind of notable points right before this actually happened, right before I saw Nick put out Sean as a clairvoyant, but it would be great if you could explain that, about, right, what did you see in the data, and then how was that then, how did that come to be in the market?
Definitely not a clairvoyant. I would say, so like the implied volatility is really the market's prediction for how much the market is going to move within some period of time. So when we talk about, say, the 30-day IV or the 30-day volatility, that's really what the market predicts how much prices could potentially move, right? It's a measure of how much movement there could be in the next 30 days. So if the market is saying there's high vol, guess what? Market prices can move not only to the upside, but also to the downside, right? And the way you get that is by looking at the prices of options. So options are sort of a way to get a forward measure of how you predict prices are going to move. So basically, if you look at volatility, typically volatility has cycles. It's like mean reverting. So a lot of the time volatility can compress, and generally when it compresses for a prolonged period of time, it's going to break out at some point, and it will shoot up and you'll see a lot of crazy movements. Similarly, when volatility is super duper high relative to, say, a moving average, it's probably going to drop at some point. So you sort of have these cycles that you can work with. And so what we're seeing now is sort of historically or over the last 30 days, a short, a period of volatility contraction. Vol wasn't too high, but now we're really starting to see it break out. So that's going to have, you'll see, a lot more like sudden price movements. We're probably going to see a few more tail events coming up. All of that is probably going to be intertwined with what we see with the Trump administration and a lot of these macro things that we'll talk a little bit about later on.
Yeah, thanks. I think the best parallel for me to understand if that is still over your head around, you haven't really ever looked at implied volatility, think prediction markets. Imagine there's a poly market for every strike, right? For Bitcoin and ETH, you can look out and say, well, how likely is it to get there? If there was a poly market for every strike over every duration, will it get to this price over this period? That's effectively what implied volatility is. It's kind of saying this is where traders are thinking things are going to go in terms of the way things are priced. So it kind of uses supply demand to say, well, why is that more in demand? Because more people think that's going to happen. Therefore, it's priced more expensively. So yeah, I think it's, for those that haven't ever explored the concept, and options can get confusing quickly, that one is super useful as a guide to what, the theory of crowds, the traders are thinking. And if we all saw how Polymarket predicted the US election in every state. Well, maybe look at some of these, options chains, options books, and therefore use that as a similar kind of indication of what might be going to happen with crypto prices.
Definitely a lot to talk about for the relationship between betting markets and option markets. Like, they are essentially the same thing at the end of the day. Options give you a probability distribution. Betting markets are bets on probability. So there's definitely a lot we can talk about there. And I think that's something we have in store for a later episode. I'll just quickly talk about this and then we can talk about some more spicy stuff. We saw skew for both ETH and Bitcoin drop quite dramatically. So skew is basically the difference in price between call options and put options at the 25 delta mark. What that essentially means is that when skew is positive, it indicates that there's a lot of call buying, right? Like positive skew means a lot of people are leveraging up. Everyone is expecting prices to go up. So everyone's going to increase the price of calls. If skew is negative, which we saw it spike dramatically downwards on Friday, that means that everyone is looking to buy puts. And puts are a form of insurance, essentially. So what we saw obviously on Friday is everyone rushed and clamored to buy puts as people worried about continued downturns. I think if you look at some of the trades that have come through, I think you saw most of this occurring for like the 31st of October. So people were buying the 3,500 put for ETH. That was, people expecting maybe it to dip beneath that. I also saw like a significant amount of buying of puts for like the 2,600 strike for the December expiry. So a little bit of a bearish sentiment coming out from the options markets there, and a lot of call selling. So people were expecting, a few downward movements and some capped upside at least, perhaps heading into Christmas. So not super bullish news there, but it could also be people panic buying and just wanting to cover their bases as we move into, as we just discussed, a period of heightened volatility. So, yeah.
Yeah, I know that we can't turn every podcast episode into an educational episode, so I won't do that. But I would say genuinely look at Derive Insights, where Sean and I both contribute content, whether it's really for those that don't know anything about options, right up to the kind of more advanced things like the kind of coverage Sean will give you on just how stats are moving once you're familiar with what they mean and how they look. So yeah, if you don't know what any of that means, there's plenty of material there to help you out.
Yeah. One last thing, just quickly, is this notion of Zcash. So everyone's asked me about this, and frankly, I didn't know very much about it heading into this week. So Zcash is basically it's a form of Bitcoin, but heavily involved with zero knowledge proof. So it's basically a privacy version of Bitcoin. So, you can protect your transactions using ZK proofs. And that this has somehow caught a lot of attention recently. So if you look at the price action, it's been around for a while now, since 2017 actually. And it's going through its booms and busts. So surprisingly, over the last 7 days, it's sort of rocketed up in price by almost 2x. And Friday's flash crash had virtually no impact on its momentum. As you can see, it had a little drop in price from 241 down to just shy of 200, but since then it's rocketed all the way up to 280. So what's going on here? I would say there's really two factors for this. Like, one is that Grayscale has recently announced that people can, or its clients, can gain access to Zcash via Grayscale. So that potentially signals some level of institutional buying. Why? I'm not exactly sure. Like, this is a $4 billion ZK version of Bitcoin. Maybe there's something there. I haven't read too deeply into it, but definitely some people seem to think there's something there. And secondly, I know Naval, the famous investor and Twitter poster, has recently shown some interest and support of it. And I think that has rallied a little bit of support behind it. But besides those two factors, I can't really explain why the price has gone up so much. But I think that's all it really has going for it right now. So I don't know, Ian, if you had any thoughts on that.
Couple of things. One, I think it's just rotation. Cash likes to find, capital likes to find the next vehicle to speculate on. And I think this one, it only needs a few key opinion leaders to back something. And when there is, I think Naval has nearly 3 million followers. So if someone like that says, and that's a pretty grand claim that he made, but even if he mentioned Zcash or any other coin, I think it would have turbo rocketed, just attracting all of that surplus rotation cash. I think also, I don't know how seriously it's been considered as a genuine ZK payment technology, but I certainly think ZK payment technology and ZK technology in general is an enormous, genuine advance for the sector. and for the tech. Whether we're seeing that reflected here, I'd be a little bit more skeptical about that. And just secondly, just to directly address Zcash as insurance against Bitcoin, I absolutely do not subscribe to that. And I think that there are many interesting, because there's a wider, I don't want to get too deep into it, but there's a wider chat here about what is the flight to safety. And I know even with my own portfolio, if you do think that we're topping out, you look to, well, what is safe, right? You told me that, dollars or fiat is debasement. So that's not safe. So maybe people are looking for an insurance against Bitcoin or some kind of safe haven from Bitcoin. And I think it's a little bit naughty to suggest that that's Zcash for the majority of people. Although, over the last 3 or 4 days, charts don't lie, and it did insulate people from the drop that happened. For what it's worth, he has a lot more followers than I do, but my advice would be, not financial advice, but my advice would be that there might be better, safer insurances against Bitcoin for your portfolio.
For sure. Like, I think the real charitable argument, which for the record, I don't particularly subscribe to, would be you believe in the technology of Bitcoin. However, Bitcoin is, whilst every address is anonymous, if you ever want to bring it into the traditional sector, you want to take it to a SEX and cash out for real money, then ultimately all of your transactions are doxed. Why not have a ZK version of that where you can do your transactions with full anonymity, and then if you need to cash out later, well, it's all anonymous. I don't think that is a particularly great value proposition. I think that there are other solutions out there to rectify that. So I'm not exactly convinced either, but that's honestly the best argument I could give for it. So yeah,
someone will be shouting sidelined as we say this part.
Yeah. Anyway, on to maybe the main course. What happened on Black Friday, right? So we can talk now a bit more about what led to this flash crash, talk about some of the specifics and some of the implications of it. I'm going to take this really well-written article from, I think it's Diogenes, if I'm pronouncing it correctly. It's been floating around Twitter. I thought it was, if it ain't broke, don't fix it. So really big credit to him. This is a great write-up. So really, the understanding that I have from what happened with Friday is that the day before, China, for those who don't know, is one of the, if not the largest manufacturer of rare earth elements. So these are things like neodymium, which are used in magnets, they're used in phones, they're used in fighter jets and military applications. And I can't remember, but from memory, I think they control 60 to 80% of the global supply. Rare earth elements, surprisingly, aren't particularly rare. They're found all over the place. Australia, my home country, has a lot of them. And I think our country's in negotiations with the US right now to sort of have some sort of sale of it. The thing with rare earths is that they're extremely difficult to refine and to convert into their final form. And so China has historically been undercutting everybody with that. And so that's why they have such a dominant dominant control of the market. And recently, as this tweet from Aaron Slodov says, China basically, weaponized is a strong word, but essentially what they did is that they prevented, they put some export controls or potential export controls on these rare earths. So what that essentially means is that if the US is trying to build a lot of its fighter jets or new fancy military equipment, China could eventually one day basically cut it off, right? And that's obviously very scary, especially when, those are the two countries that are probably going to have a flashpoint at some point, if there ever is one, in the South China Sea or around Taiwan. So this is a bit scary if you're the US or a military manufacturing company. So basically, a few things happened. Trump originally refused to, or threatened to call off meeting Xi Jinping at upcoming meetings, and then put out a Truth Social, which I don't have here, unfortunately, where he basically said he was going to slap 100% tariffs on Chinese imports. Obviously, that's not very great because a lot of things are imported into China, and that's what set the market into a frenzy downwards. So apparently it happened at 1:57 PST. And then that's pretty much what set off a lot of this this dumping. And so sort of have been through a lot of the numbers before that. Some interesting numbers on open interest. So basically, you could see open interest halved over the October 10 to October 11 period. Something we can talk about later as well would be this idea of auto deleveraging. And I think, Ian, you have a few thoughts on that, because frankly, whenever you start talking about auto deleveraging, things are very, very wild. And then we can talk a bit about some market downturn. Market platform shutdown. So Lighter, I personally experienced this. Lighter went down for a couple of hours, which wasn't particularly great. So people couldn't close out their positions, people couldn't hedge effectively, and that obviously resulted in a number of other liquidations. Finally, one thing to note would be like Aave in particular had a substantial amount of liquidations, its new record of 180 million. So that's a lot of people who borrowed a significant amount against their ETH or Bitcoin, or their alts, and those tumbling in price and subsequently getting liquidated. So yeah, maybe I'll pause there for now. Ian, what are your thoughts?
Yeah, again, it's just tempting, isn't it? There's so many factors at play here that you could do an awful lot of talking and content around the wider macro that's driving all of the geopolitical situation. And honestly, my thesis, and I tried to build this out in parts of my Substack, although I haven't got to the heart of it yet, is this kind of like 40-year play that America has made on, kind of backing the dollar and backing treasuries and offshoring everything that they used to make. But I'll resist following the piece of thread. But I think that effectively, I think that this is like the pointy part of the spear when Trump starts to have arguments with China about tariffs. There's all that at play. I think there's way more at play than people realize in terms of the depth of the power shifts and the changing world order, as Ray Dalio would categorize it. And then there's the fact that it's already happened, right? We've already had a tariff war. Trump already raised the tariff and got out the famous whiteboard and just kind of wrote people on and put people at 80%, 70%, or if you're in my hometown of the UK and have the special relationship, you did a little bit better out of that. So I think once the market has already had that horrible effect with tariffs and already fallen as a result of instability there, it almost knows the playbook, right? So the threat of it happening again is another way that the market says, oh, we know how this story ends. So I'm afraid that's a massive crashing right now, because there's a degree more predictability about how tariff wars might affect the market than there was the first time it happened, when it was relatively unprecedented. But yeah, great write-up just to see kind of how the pieces started to happen in real time. But I think the experience a lot of people would have had is just, why is my coin crashing? Particularly if you're in some kind of long tail alt. It didn't quite happen as kind of 0 to 90. It was 20, 30, 40. Oh, it can't go again. It's okay. We've leveled off a little, 50, 60, 70, 80. So yeah, it's a horrible experience. And I do want to say, if it's your first cycle and you did get liquidated or you did lose some money, it really is like a rite of passage. I've certainly done it, and I consider myself a relatively conservative trader, but I haven't always been like that. And I think part of it is just kind of chasing wealth effect, and that's why a lot of the content I've been putting out there is, a lot of the kind of Warren Buffett style stuff, which I don't always agree with, but the market rewards the patient. And if you just gently compound into wealth creation, then that makes a lot of sense. Versus the impatient are those that have just been liquidating and transferring their money to the patient who weren't looking for the big returns. But yeah, I'm not here to lecture anyone after that happened, but I understand it.
Well, one thing that makes me very impatient is this following trade. So in the midst of, well, not in the midst, at the start of the massive dump, there are people speculating of a very big piece of insider trading. So just before Trump announced his 100% tariff on China, as this Cabesi letter tweet points out, this large whale opens I think it was a $200 or $400 million short across ETH and Bitcoin using $80 million of collateral. They did this on, as I understand it, Hyperliquid. It was a brand new account. It had never traded before. And they opened this huge short position. The market promptly tanks. And at the very bottom, they close out just as Trump also announces like a potential walkback um, of the tariff. So there are a lot of people saying that this is someone inside the administration who obviously is privy to this information. I think a few people on chain have been doing some sleuthing, and so this definitely has like a smell to it. And it's very convenient that this person puts on this huge short position merely minutes before Trump announces a very significant piece of geopolitical action by the United States. So definitely something, and I think at the end this person profited $192 million. So a very good trade, though perhaps one informed by certain pieces of information. So yeah.
Yeah, not going to point any fingers, but the only thought that the seed I would plant would be to say, what are the ingredients you need to make that trade, right? You need incredibly privy information. You need a very and timely. You need a real-time connection to some of the biggest decisions in the world. You also need to have $80 million on chain. I think that I don't know how many traders that is in total, but it's not very many. So I think if you just kind of put some of the ingredients together, you can probably get a good idea of, if I was investigating this, who I'd be talking to. But yeah, nothing. It's pure speculation. I don't know, but those are the pieces that were the most frustrating to watch when it's so extractive to do something like this. But there you go. Insider trading is extractive.
Very extractive. So look, I don't know the identity of this person. I'm sure with enough sleuthing it could come to light, but for now it definitely does have there are some question marks surrounding it, to say the very least. Anyway, this brings us to maybe the next point, which is, what is the value of these coins, right? I won't dwell too much on this tweet, but I found this was very funny. How did my frog and cat coin fall 99% in 30 seconds? I think if you are asking that, like, you sort of, as the Joker said, you get what you deserve. Look, when you're trading meme coins and you're trading them on leverage, this is not investing, right? Like, this is essentially a more accessible form of gambling. So, yeah.
The only bone I'll throw anyone who does feel like that is, it was only a year ago at Token 2049 that Murad gave this talk, right? And everyone's like, oh, some of these coins are new religions. And I think the really clever piece of marketing that he did was, if you don't get it, you don't understand, right? If you have a counter position, you don't get it. That's it. So, and certainly don't want to make this a discussion about religion, but like, faith is a core concept to religion, right? And I think he was using that to push coins by saying, if you have to question whether this is the next mega coin or not, then you have no faith, and therefore fundamentally you're not part of this cult. And I think that is just such a powerful, structure, such a powerful heuristic to kind of sell to people, that maybe we're only talking a year later. So if you went all in, and let's say maybe you 5x'd along the way and it changed your life, it's understandable to some degree that people were like, this has happened so many times through crypto that you've kind of picked the latest thing. So yeah, I get that they're making light here of like my frog and cat and fart coins and whatever they're called, but people have made a lot of money out of them. They want to get into something in an increasingly kind of, the rich are only getting further away from the poor in terms of the concentration of wealth and capital. I think there is some desperation that leads to over financialization and gambling led. It's people's only chance to get out of a rut sometimes. So I think there is a darker side to this, and it's understandable why people said, but there's absolutely no substitute for a strong financial education so that you're managing your finances in tried and tested methods that have worked for 100 years. So yeah, this is the casino, and there is no crying in the casino, but I understand if you are.
Yeah, look, I think I definitely agree. Like, a lot of people have made a lot of money trading these coins, and to that I would say, on the religious note, what the Lord giveth, he also taketh away, right? Like, be careful out there. It's very easy to make that money, and people just keep gambling it up and up and up, right? Like, at the end of the day, money is a means to an end. We're all going to die. We all can't take it with us. And yeah, I fully agree that there are a lot of people who are forced to take these very high leverage bets because of other circumstances in their lives, and that's extremely unfortunate and frankly an indictment of capitalism maybe as a whole. But be careful out there. It's the end of the day. I think these coins are they are a leverage bet, and anything that has the word leverage in it, especially things that have things like fart and frogs and coins on them, those are probably things to be careful around. So yeah. Speaking of being careful, Jeff Park had a really, really good piece that I saw. I won't go through the whole thing now, but I'd encourage everyone to read it. But really, it is a criticism of perps. And perps, as I said before, they do have a place in crypto, and they are fun instruments. But there's a really, really good line here that he says, in that perps appear to be long volatility, but they're actually short volatility instruments. So I think that is something I wanted to talk about very briefly. Like, when we talk about long volatility, right? To say you're long vol means you make money when prices move in whatever direction. It could be up or it could be down. So when you're trading options, you'd be buying straddles or strangles. You'd be long volatility there. Now, like, maybe some real pro traders might correct me, and maybe I'm abusing the notation here, but what Jeff's saying here with perps like really resonates with me, because when you buy a perp, people are like, yeah, I'm long vol, right? Like, I make money if like the market does super well. Kind of, right? Like, you only make money if the market goes in one particular direction. If you're long, these perps, you only make money if the price goes up. If you're short volatility, if the price goes down, guess what? You're going to get liquidated. Perps are fun. Perps have a place. They're great hedging instruments. They're great to make short-term bets. But as a lot of people who have been, say, scam-wicked, liquidationed, like, they can be really terrifying instruments, right? Like, I can't tell you how crazy it was having to manage my position on Friday, making sure I had enough margin, having to close out positions when there's absolutely no liquidity. That is terrifying, because if the price drops too much too quickly, even if it rebounds, you've already been liquidated. And that's really an unfortunate thing about perps. That is a feature, not a bug, unfortunately. Now, like, as options evangelists, Ian and I will always take the opportunity to shill options. That's the beauty thing of options, right? If you do want to make a long bet that prices are going to go up, you can buy an option, you pay some premium, and you can walk away. And if prices wick down 50%, you have zero chance of being liquidated. And that's a really powerful proposition when you come into these tail events like we saw on Friday. You kind of do want to have that ability to like look away from the screen, because your entire account isn't about to blow up. Sure, those options might expire worthless, but everything is sort of self-contained. You don't have to worry about, one particular option of one particular perp position you have dragging down your entire portfolio and you realizing a massive loss as you get liquidated. So I don't know. I think that this piece was really good. I'd encourage everyone to read it. I don't know, Ian, what are your thoughts?
Yeah, I like. I mean, Jeff's a big proponent of options, but and also of Bitcoin, and has always been an interesting read. I think I actually posted on his tweet with something probably very similar to what you just said around kind of. I think an options education and risk management is a. What did I say? It'll be fascinating when crypto learns to trade options and to use risk management, and that was I'm becoming a broken record 2 episodes in, but I really, really subscribe to that. And I think that, they're not perfect, right? Options are not the perfect vehicle because they're still tricky. It's not like some easy, I'll go buy options and I'll make money when I wouldn't have made money on perps. There are different challenges, like the time frame. You have to pick a price you think you're going to go to, and you have to pick by when. And you don't have to do that with perps. But, pros and cons. You can't get scam wicked, but you've got theta decay. So if that timepiece you've got wrong, then over time you're bleeding value. But I just think there's a reason that they are used by TradFi and they are used by major financial institutions as a way to hedge and manage risk. But but I think the point here is no one was trying to hedge and manage risk with these perp trading, right? They were at the casino having fun. So I mean, I don't know if any of these people who are trading perps have actually been to casinos, but I'm aging myself here. Back in the day, when casinos were the way to go have that fun after a night out, many a time I had a great night and then ruined it in a casino and didn't have money for the taxi home. So I feel like it's that feeling, but the leverage didn't exist, right? If I could go to a casino and do a 50x, 1000x bet, then I might have just lost my house when I came out of that casino. So that's what I think's been happening, reflected in these digital markets.
For sure. Um, So, talking a bit more about leverage, we touched on the idea of Wintermute earlier. There's this tweet here. People were messaging people at Wintermute asking if they're okay. You'd see speculation of Wintermute having blown up. Now, what probably happened here, right? I'm purely speculating based upon my understanding of, having been in the space for the last couple of years. When there's a sudden price movement, market makers such as Wintermute pull quotes or make their quotes super wide, right? Because no one wants to be quoting very deep and very tightly when prices are dropping 5, 10, if not higher percentages. Now, what that means is that the book becomes extremely sparse, right? So there's very little liquidity on the book. And two things are happening. One, people are panic selling, right? Because shit, it's going down 10%, time to get out. And two, people are getting liquidated because the price has gone down and everyone is levered up. Now, both of those two things will mean that prices go down further. But now there's no liquidity in the book. And if there's no liquidity in the book, those forms of selling, the liquidated people, as well as the people trying just to desperately get out of their positions, those are going to have an outsized impact on the price, right? So market makers are going to make their quotes even wider, and that's going to send prices even further down. And it sort of becomes a self-fulfilling prophecy. Prices go down further, more people get liquidated, more people want to sell, prices go down even further. And that's sort of what you see with a lot of these things. Now, Wintermute are a bunch of really smart guys. I'm sure that they understand these mechanics. And I'm sure that they have risk metrics in place to ensure that these things don't occur. So the claim that these people probably blew up because it's indicated by how they started quoting super wide at those points, that's really just a reality of what happens when you have such a dramatic price drop. And frankly, it is sort of self-creating, right? Pulling your quotes makes the price drop even more severe, and it just happens. But at the end of the day, I haven't seen really any compelling evidence that anyone has, has become insolvent or, had too bad of a day. So, especially
it's possible, right? It's just why would they be that directional? They just don't need to be, right? They could just be completely neutral and do fantastically well. And like you said, use all of they don't have to quote, they can, in a situation like this, making a market's not really a thing that, you need it, but no one's going to just take the loss on behalf of the crypto community and say, oh yeah, I'll underpin everything and just create a floor here. It's got to be supply and demand and market efficiency underneath everything. So yeah, I don't see any reason that they would be. And whenever we've seen someone blow up, it's because someone's taking crazy risk behind the scenes. So yeah, if Jenny suddenly decided, oh, we're going to be directionally long here on the whole portfolio of this company, it took me so many years to build. Oh no, it went down a lot. That just seems like a ridiculous scenario that I think is very unlikely from my perspective.
I also find it hard to believe that there would be directionally long. Typically, if you're the market, if you're quoting these alts, the people who are on the long side of those alts are typically retail traders, right? They want to go long AVAX or they want to go long hype, right? Not many people want to go short those tokens because, frankly, if you're retail and if you're in crypto, you're probably betting everything is going up. And if those people are long, that means that the market makers have to be short. And they probably have, hedged that by having a lot of the spot asset. So frankly, they're pretty much delta neutral. So I don't know. It sort of fails the sniff test for me. Maybe there's some information that I'm not privy to, or some on-chain sleuthing people have done. But frankly, like I don't see any evidence that really compels me to believe that there's any worries on this front. So I think it's a bit of a nothing
Same.
burger, honestly. Yeah. Um, so speaking of risk, Ian, maybe you want to talk us a little bit through auto deleveraging because this has been coming up again and again, especially with regards to hyperliquid, I believe.
Yeah, this was a fantastic. I love these tweets that come out explaining things. The sad thing about this kind of tweet is that they tend to come out when it's too late to explain why everyone just kind of should now become aware of a new thing that they had to get liquidated before they would understand. But whether you're trading on a SEX or a DEX setup, you'll always see some kind of indicator. It's often kind of colored bars, like a traffic light system that shows kind of almost where you would be in the queue based on your size. Or I should start with ADL is auto deleveraging, and this is to do with the leverage that's inherent in the system of perpetual futures or perps. That if there's a cascade like Sean just described, where almost in either direction, but certainly let's just use Friday as an example, where the price is dropping. In order to fulfill the other side of these positions, the exchange needs to recover the collateral. And in order to kind of pay the other side before things get out of hand and they cannot be covered any longer by the value of the collateral. So they will, like an orderly fashion, start to literally force sell those positions, unwind those positions, and cancel out the trades. The problem with that is each exchange has a different ADL algorithm, mechanism, structure, set of rules by which they do it, and no one took the time. This is like, so many examples of the meme is like, read the docs. No one ever reads the docs. No one ever knows how the product actually works. And this has a genuine level of risk to it, and it's something that you can that you should be kind of building into more serious models, certainly institutional models. So probably the winner of the whole ADL position, and again, I don't want to go too much into the weeds on it, but Hyperliquid did pretty well here. I mean, it worked. It did what it said it was going to do. They processed all of the forced. No one wants to be liquidated, so I don't think anyone's going to give them a round of applause. But actually, from a product perspective, it did exactly what it was intended to do. Whereas I think Binance had a little bit of downtime. A few people went out and had downtime, but there was also criticisms that some of the ADLs felt like they didn't play honestly with the mechanism. So the reason that trade was closed didn't feel like, looking at the evidence, that it was specifically because the collateral was under threat, and it was more kind of convenient to just wash out a bunch of trades that suited them. But it's speculation, and certainly with the on-chain stuff, you can do more research there, more granular research as to what happened. But I think that the takeaway for me from Friday and ADL is just be aware of it. Whichever exchange you're trading on, go take a look how it works. You're certainly you shouldn't be among the priorities for ADL unless you are using lots and lots of leverage or you have a huge position in terms of the base collateral. There should be a lot of people that are going to be affected by this before you, but with really good planning and really good trading, it won't be a surprise. You'll be aware when you're at risk of it.
I think all this talk of ADL, I agree with all of that. I think all this talk of ADL makes me think that this was a huge washout of leverage, right? Whenever you hear ADL, that is a last resort of an exchange. Basically, it means that if they don't deleverage people, that means that either they're going to have to go into their security funds to cover people who have become insolvent, or else there's not enough money to pay out the longs, or like that there just won't be enough money to cover those positions. Because you saw such a huge swing in, mostly these alts, stuff going down 80% in like 5 minutes, that will blow through any margin you have to post. So like if you have a $1,000 trade and you post $200 and you have an 80% swing against you, you've lost $800, but there's only $200 in the system posted by you. And so that's when that auto deleveraging has to take place. And really, like the fact that there was so much of it occurring on Friday is really a reflection of just how much leverage there was in the system, presumably on these these alts. And now that's all sort of washed out. Like, you will see, a lot of the mania that we've been observing over the last couple of weeks dwindle down. And I think that's probably a good thing, right? Like, you don't want to have like excessive levels of, a bubble, for want of a better term, building up. And we'll talk a little bit about this in a minute, but these things happen. There's always going to be a washout of levered positions. We just saw like a particularly bad one occur on Friday. So it's all part of the cycle. This all happens every so often. It's nothing too new. The auto deleveraging is a little bit worrying, but that's basically a reflection of just how much leverage there was in the system. So it was sort of overdue for that correction, in a sense. So yeah, just market things. So on that, I guess one thing would be, where are we at in the cycle, right? Like, if we had our downturn, like, did we just cross the top? Is that a local top? I know we talked about this in our last episode. So here's this tweet from CoinCompass saying that 0 bull market indicators have flashed this cycle. And if you can't see it, the consensus is 100% hold, on a scale of 100% hold to 0% sell. So really what we're seeing is a big flushing. So everything's back to normal. Are we at the top of the bull cycle? I've become maybe a little bit more bearish in the last week or two. And we can talk a little bit about that. I see Ian grinning quite a little bit there. One thing that has me particularly worried is sort of people talking about all these tech companies essentially doing a more legitimate form of round tripping. So round tripping is when, you have multiple businesses, each paying the other business for, its own, for various services, where the money sort of does a round trip. So here, as an example, you have Oracle spending money at NVIDIA. NVIDIA is giving money to OpenAI, which is then giving money back to Oracle. The values that we're dealing with here are insane, right? It's $200 million deals, billion dollar deals, $300 billion deals, and so forth. And Ian is the AI guy here. My take on AI is it is extremely good. It is something I personally use on a day-to-day basis, but it does not justify this level of valuation. And the fact that you're seeing this financial engineering taking place has me a little bit personally worried that this is a bubble. Now, I will charitably say, and we can talk about this at a later date, there is the argument to make that these companies are now almost too big to fail, right? The Magnificent Seven and these adjacent companies are just so big and so critical to S&P 500 and everyone's 401ks and just generally wealthy people in society, that they can't be allowed to fail. And I'm not suggesting that any of these companies are going to go bankrupt or anything, but could they be due for a massive correction, 20 or 30%? It's not out of the question, right? A lot of this has been driven. I think I saw a stat today that 70 to 80% of the S&P 500's gains over the last year have been from AI related activities. That feels a little bit bubbly to me. So could we be due for a correction in the broader market that obviously finds its way into crypto? I would say that that's starting to become a much more likely possibility. So what about you, Ian, as the AI guy? What do you think?
This is the interesting thing, right? This has nothing to do with AI. This is it a market bubble? Yeah. Is there anything to do with kind of the capabilities of LLMs or the capability of token predictive technology? No, it's nothing to do with it. It's an amazing revolutionary technology that is evolving faster than any tech we've seen ever. But imagine being in the internet bubble on the way up and then saying, is this internet thing any good? Yeah, it's really good. It's going to change the world. But the speculation inherent in the companies that are building it, yeah, that might not turn out exactly as you're expecting. Maybe you're over speculating on that. So I think, first of all, it's we all want the winning horse. We all want to back something. We all want to speculate on some winner. Whatever vehicle that takes, it's almost unlucky if you happen to be, or lucky, depending on your plans for the business and what you're trying to do. If you're raising or selling, it's pretty good. But if you're trying to maintain an unrealistic valuation, it's not so good. It creates an unhealthy pressure. The second thing I'd say is ultimately it's about macro. Fundamentally, crypto's always been macro driven. It's had some at the beginning. It had insane, levels of beta and reactions to what was going on, and huge volatility that seems to have kind of matured a little bit now. But I don't. So like to summarize, I think is it a bubble? Absolutely, it's a bubble, no doubt about it. Has it burst? I don't think so. So to me, it's like when then? When do I go risk off? So if we distill it down to risk on, risk off, we've got the dot plot has, I think, 2 rate cuts before the end of the year, and then another 2 or 3 into March. So if we're going to come down another % in rates, cash is about to become ubiquitous again, and we're going to grease the wheels, if anything. So my personal take on it is not has the bubble burst, but when will it? And how much better could it get before it does? So I effectively think we have, if I'm speaking in Elliott wave terms, I think we have a wave 5 to come. I think a lot of traders are looking at that kind of structure. And I think I'm not a diehard Elliott trader, but I think that really fits here. And to the last tweet you showed, are the indicators flashing? No, not yet, but they will. They will. So I would say have a plan for what risk off looks like for you. Trim some off the top. If you have been lucky enough, Sean and I were joking earlier this week about gold and who was in gold and who wasn't. And I was lucky enough to get into gold and really play this whole, particularly I had some great plays in miners, which I think have done incredibly well, but have done so well that it would be criminal not to take a little bit off the top no matter what happens. And I do not think they're done. So I'd say take some profits and sleep at night. And remember, coming back to this crypto situation, this was a spot win, right? You only had to buy crypto miners in January, February, and you're 100% up. So that, don't kid yourself by saying I can only make those returns in the casino that is crypto, in the dog coin or the frog coin. Just understand that wider breadth and rotation happens in the market and have a plan for what risk off looks like. And then if you've hit your targets, have a look at the conditions. And if you hit your targets, make a decision to say, that's enough. That's what I set out to do. I'm done. Or, well, the wider conditions show no sign of stopping. So although I'm beyond my targets, I'm going to hold for this to happen. So that's my, I don't think that's actually, I use none of my AI knowledge and my geekery around AI there because I don't think it's anything to do with it.
No, sounds good. I think we'll wrap it up on the last point, just talking a little bit about gold. I know we were going to talk about this earlier in the week, but how about you take us through what's happening with gold, Ian?
I don't see any signs of exhaustion, right? I mean, I think it's the perfect storm. I think that it's like look at so many of the most popular trades, where most of the popular capital is. And I think that let's keep it crypto related. It's at the heart of the debasement trade. So if you believe that via inflation, I don't even know if this is if you believe anymore. Maybe you can just say it as a fact. Major fiat currencies are being heavily diluted via the printing of money and via inflation over time, which protects the wealth of the very wealthy and doesn't do so well when you're trying to buy milk and bread at the local store. So anyone that believes that when they go risk off or they want to take some risk off, they've got a couple of choices really, haven't they? Gold has just got way more inherent trust because it's been the store of value for such a long time. Fort Knox is full of it. So I think it's kind of got the whole debasement trade, people not trusting fiat and saying, I'd rather be in gold. Then you've got all of this geopolitical tension around warring factions and, until the last few days, the Middle East and then Ukraine and these kind of cold wars that are constantly threatening. Gold is a nice kind of backstop for that it will hold a value through that. And then lastly, I think you've got the speculative angle now that it was this safe asset. Suddenly it goes parabolic and FOMO money finds its way there and says, hold on, this is outperforming Bitcoin. Maybe gold is the trade I should be in. So I think gold is a great part of a portfolio that goes risk off. And maybe you do balance it with some US treasuries or some treasuries in your own country or or some Bitcoin. You know, if you believe that that's also with a fixed supply, similar to gold, it can have a value. But I don't see it. It kind of plays exactly into what I just said, Sean. That I don't see any signs of exhaustion. I'm nervous because I'm so far ahead of my targets for those trades, but I'm going to hold out until all of the indicators that I look at, like yield curve inversion, or liquidity factors changing around rates, that might flash to me. Take another look and do something. But for now, nothing on my dashboard is flashing, and I'm happy, moisturized, and staying in my pond of lily pads. I can't remember the rest of the quote.
No, sounds good. Well, that's all I had for the week. Ian, do you want to wrap us up?
Just the last thing I wanted to say was, if you got totally wrecked here and you're struggling, money is not. I know it feels like everything right now, but please don't do anything silly, because these things happen and these stories start coming out. Don't be the person that succumbs to that. Speak to people, communicate if you're having problems, and don't assume that your entire value as a human being is about your trading performance in the last 3 or 4 days. It might feel like that right now, but in a week's time, a month's time, 6 months' time, you might be better off than where you were on Friday. So I just wanted to speak to the people who are genuinely having a hard time with what's happened.
No, well spoken. So, yeah. Well, thank you for joining us for this episode of the High Signal podcast, and we'll be back sometime next week. And yeah, stay safe out there. It's probably going to be a volatile week. So, catch you then.
Thanks, everyone. Bye.